Dannylau here with Lion Real Estate, empowering individuals and families with financial success through real estate. Hey, you've seen it all over the news headlines lately. Interest rates just climbed over 3% in recent weeks, in recent days. It's as high as it's ever been since January of 2021 when it bottomed out in terms of historical lows. And so, what does this mean for you as a buyer in this market? Well, all the talking heads in the industry are anticipating that real estate interest rates, interest rates, and thus mortgage rates will increase in the next 12 to 18 months, especially with the Fed's bond purchase tapering off. And so, of course, nobody is going to know the future. However, as a buyer, even though you may not be able to lock in as low of an interest rate as you might have been able to 3 months ago, does that mean you should wait for a purchase, or does that mean you should wait for a better mortgage rate to come around? And so let's run a quick scenario, because let's say the mortgage rate is going to go up by half a point. Right now, it's slightly over 3. Let's say by 12 months from now, it's going to be 3.5 something, 3.625. And so in this scenario, if you have a mortgage amount of $350,000, the difference in payment is roughly $100. And so you're actually decreasing in purchasing power as a buyer if you wait and the interest rate ends up going higher. Keep in mind, even though, once again, you may not be able to lock in an interest rate as low as what it was 3 months ago, it is still incredibly low in the historical perspective. And so anything that is under 4%, really, I remember there was a day that we were hoping and praying that interest rates was going under 4%, and we're all jumping for joy for sub-4s. And so there is a trade-off to be made when you as a buyer is considering waiting. Now, of course, there is a give and take for when there's an inverse relationship between the interest rates and asset pricing. And so as interest rates goes up, the real estate prices possibly can come down as well. But here is another piece of the argument I want to make. Because of the historical low interest rate that was behind us, a lot of existing homeowners actually took advantage of the low interest rate to refinance their homes during that period. And so now that they have locked in this bottom interest rate and extremely low mortgage amounts, it actually disincentivizes these homeowners to sell the house to look for a new place, because what's going to happen when they go sell their old house to find a new place is not like they can take this low mortgage rate with them. And so when they go somewhere else, now you're paying a higher mortgage amount and a higher interest rate. So this phenomenon actually further decreases liquidity and decreases the inventory on the supply side of the real estate market. We have already been complaining about low inventory, short supply for the last few years. It got further and further illiquid as time went on. And so based on a really red hot real estate market driven by high demand, extreme low supply, the low interest rate slowly ticking up is a self-reinforcing force where I don't see real estate prices dropping significantly in the next 12 to 18 months. Of course, no crystal balls here, but once again, if you as the participant, as the buyer in this market, and you decide to wait on the right opportunity in terms of finding the perfect interest rate, I would say it's more important to find the right house, to find the neighborhood that you want to live in, and to find where you want your family to grow up in, rather than shopping for the exact moment where the interest rate is going to bottom out again. Well, that concludes tonight's video. Let me know in the comments below what you want to talk about next time. Please click like, hit subscribe, and we'll see you next time. This is Danny Lau. See you next time.